In this segment, we'll look at forecasting fixed assets and depreciation, and then continue with current operating liabilities such as accounts payable and accrued expenses. Fixed assets include things like buildings, equipment, and machinery that are used by the company over many years. These assets are often referred to as property, plant, and equipment, or PP&E. As we saw earlier in the course, since assets like these are going to be used for more than 1 year, their cost is not recognized all at once on the income statement. Instead, the cost of these assets is first capitalized as an asset. Then, as the asset is used in the business, the cost is allocated to the income statement as depreciation expense. Given this close relationship between depreciation and fixed assets, these two accounts are usually forecasted at the same time. Forecasting purchases of PP&E, or what we call capital expenditures, can be difficult without some explicit guidance from the firm. Fortunately, for many public companies, guidance can be found in the management's discussion and analysis section of the annual report. In addition, press releases and quarterly earnings reports will often include some mention of planned capital expenditures. If there's no publicly available guidance, then you must rely on examining historical data to see if there are any observable trends that can be used to make a forecast. For most firms, capital expenditures are driven by their long-term growth and production plans. For NEBCO, we can assume that their initial investment of $1.2 million in PP&E gives them sufficient production capacity for their first 2 to 3 years of operations. Thus, we expect no new purchases in year 2, with the possibility for increased expenditures in year 3. Once capital expenditures have been estimated, you can then estimate depreciation expense. Again, assuming no change in PP&E except for any planned capital expenditures, depreciation expense can be expected to be the same as last period's depreciation expense, plus any new depreciation on the new capital expenditures. To estimate depreciation expense on new purchases, you must have some idea of the time period over which the firm depreciates its PP&E. You can do this by comparing annual depreciation expense with the original cost of the PP&E. For example, NEBCO depreciates PP&E of $1.2 million. We see that in year 1, depreciation expense was $120,000, as this is the balance in accumulated depreciation at the end of year 1. Dividing $1.2 million by $120,000 gives 10. So we can assume that on average these assets are being depreciated over a 10-year period. Knowing this, we can estimate depreciation expense on any new purchases of PP&E based on a 10-year useful life. Since NEBCO had depreciation expense of $120,000 in year 1, we would estimate next year's depreciation to be $120,000 plus any year 2 capital expenditures divided by 10. Given we aren't forecasting any capital expenditures for year 2, we will forecast depreciation expense to remain constant at $120,000. Finally, we will assume no change in other assets. One thing that can get confusing when forecasting PP&E is the difference between the gross and net presentations of PP&E and the related accumulated depreciation. In the gross presentation, as you see here with NEBCO, the original cost of PP&E is listed first, titled PP&E gross, and then accumulated depreciation is subtracted to arrive at PP&E net. That is, PP&E net of accumulated depreciation. If NEBCO were to use the net presentation, all that would be shown is the net PP&E line without separately listing the original cost and the accumulated depreciation. When you look at the two presentations side by side, the only difference is the extra detail you get with the gross presentation. When forecasting using the gross presentation, estimated capital expenditures are added to the gross amount of PP&E, and estimated depreciation expense is added to accumulated depreciation. PP&E net is then just calculated as the difference between the two amounts. Under a net presentation, you only have PP&E net to work with, so you must add the forecasted capital expenditures and subtract the forecasted depreciation expense directly from the PP&E net amount. As you see here for NEBCO, you'll end up with the same amount for forecasted PP&E net, just two different ways to get there. Turning now to forecasting some of the current liabilities that are operational in nature, let's first look at accounts payable. Accounts payable is a working capital account directly related to our purchases of inventory and our sales forecast. We can forecast accounts payable with the similar options that we use for accounts receivable and inventory, either based on the accounts payable turnover ratio or as a percentage. But since accounts payable are usually linked to inventories and cost of goods sold, that percentage is computed in relation to cost of goods sold, not sales. For example, in year one, accounts payable of $300,000 was slightly over 14% of cost of goods sold. We are already forecasting slightly lower turns for both receivables and inventories for NEBCO as the firm goes through its startup phase, grows its sales base, and works out the kinks in its production process. What this means is that inventories will take a few more days to sell, and receivables will take a few more days to collect. To try to balance this out, we can expect NEBCO to also try to take a bit longer to pay its suppliers, leading to a slight increase in their payable balance. Of course, NEBCO will have to be careful not to damage its relationship or credit standing with its key vendors. Thus, accounts payable is forecasted to increase as a percentage of cost of goods sold from 14.3% to 16% in year two. Other current operating liabilities include accounts like wages payable, taxes payable, other accrued expenses, and other current liabilities. These accounts are usually forecasted as a percent of sales, or if they are more directly related to a particular expense account, such as cost of goods sold or selling general and administrative expenses, they could be forecasted as a percentage of those expense accounts. For NEBCO, their accrued expenses liability account is a general account that is likely related to various operating expenses, both SG&A and probably some R&D expenses as well. Thus, we can forecast this account based on its relationship to the overall level forecasted for both SG&A and R&D expenses. In year one, accrued expenses of $120,000 was 14.1% of total operating expenses, which included both SG&A and R&D. Consistent with our other forecasted accounts, we might estimate a slight increase in this account to 15% of total operating expenses.